Hello! In this lesson we're talking about Chapter 2, and I need to mention that I found that because YouTube has a limitation in terms of video size or length, my coverage of problem PA2-1 was a bit long and ended up taking up 4 separate videos, and so I need to make an effort to speed up my presentation, and that's going to be a little tricky because I hate to rush through material, and so I'm going to try my best to balance a complete coverage with the time factor. Okay, so if we can do this over a couple of videos, that'd be an improvement over Chapter 1. So anyway, Chapter 2 covers a lot of information. It introduces a lot of material, focuses on the balance sheet. What I've done here is I have kind of restated the accounting equation a little differently from the previous lesson presentation. This equation format shows simply assets, liabilities, and owner's equity. And under owner's equity we see revenues and expenses. So the main focus when we look at the 3 categories presented on the top line is the balance sheet. The balance sheet shows us our assets, our liabilities, and our owner's equity. And we call it a balance sheet because the total of our assets must always be equal to the total of our liabilities plus owner's equity. Revenues are added to owner's equity. Expenses are subtracted from owner's equity. And we saw how the income statement, which is basically revenues minus expenses, the income statement is tied to the statement of owner. It's tied to owner's equity through the statement of owner's equity, or for a corporation, the statement of retained earnings. And the way it's tied to it is we first calculate net income by taking revenues and subtracting expenses, and then that net difference, which let's say is the net income as long as revenues exceed expenses, that net difference is then added to retained earnings, which is part of owner's equity or shareholder's equity for a simple corporation. So the total of owner's equity plus liabilities must always equal assets, and that's basically our balance sheet presentation. Now if we just kind of quickly thumb through Chapter 2, there's a few things I'd like to make note of. On page 47 it mentions financing activities in Exhibit 2.1 and investing activities in Exhibit 2.2. I think it's important to note and keep in mind that the investing activities of a business are basically those activities or transactions which result in the purchase, or it could be the sale, but the purchase of long-term assets. So in other words, the business is investing in long-term assets, and those assets, like any assets of a business, should be an integral part of that business operation in terms of that business being able to generate revenue and earn a profit. So that's investing activities. Above it investing activities are shown in Exhibit 2.2. Above it in Exhibit 2.1 are financing activities. Financing activities, as the name implies, are those activities or transactions which reflect how the business is financing its operation, or more importantly, financing its investments in assets. And basically a business has two options by which it can finance investment in assets. Let's say expansion. So we need to buy assets. You can finance it by taking on debt, taking out a loan, or you can finance it by selling equity interest, or in the case of a corporation, selling stock to owners or to potential owners of the corporation. So you can finance your operation or finance your investments either by borrowing, which would result in a liability, or by selling equity interest, which would result in an increase in owner's equity. Okay, moving forward, starting on page 49 and moving forward are a number of examples of different types of transactions. And on page 49, step 1 is shown as analyze transactions. Keep in mind the steps in our accounting cycle which we covered in a previous lesson. First step is to analyze transactions. When we analyze a transaction, we basically figure out what type of transaction it is, and we need to get the details relating to that transaction. Things like date, amount or amounts, parties to the transaction, etc. The second step, closely tied to analyzing a transaction, is to classify a transaction. And as I mentioned in a previous lesson, classifying a transaction is probably one of the most important steps or parts of bookkeeping and accounting. Something that a lot of people don't really understand initially, and a lot of students especially think that accounting and bookkeeping is more a matter of math, whereas what it really comes down to is classification. And when we classify a transaction, basically what we're doing is coming up with the account categories that are affected by that transaction. That's very important. Which accounts are affected by each and every transaction. Something I didn't mention in the previous lesson is relative to what is called double entry accounting or double entry bookkeeping. Each and every transaction always must affect two or more, but at least two separate account categories. Okay. Now, the classify transaction step isn't noted individually in the text material. It's really incorporated into step 1 under analyze transactions. If we move over to page 54 in the chapter, there are shown steps 2 and 3, record and summarize. And as noted in the previous lesson, our step 3 in the accounting cycle is to record transactions. We cannot record a transaction unless we first analyze it and classify it. We need to figure out what the transaction is and which accounts are affected. Then we can record it, and following the recordation process, we would then summarize our transactions. There are a number of steps involved in summarizing transactions, And ultimately, the last summarization is in the form of our final product, which is our financial statements. And then finally, moving forward again, in the chapter, the last step in the accounting cycle isn't shown in this chapter, but as you recall from a previous lesson, the last step after we have prepared our financial statements is to again analyze and interpret. This time we are not analyzing transactions individually, rather we are analyzing our finished product, which is our financial statements. So these are the major steps in the accounting cycle. Chapter 2 also introduces the journal and the ledger, the formal, more traditional recording process for accounting is shown on page 58. Transactions are first recorded in the journal or the general journal, and then those amounts are transferred from the journal into the ledger or the general ledger. And that process of transferring amounts from the journal to the ledger is called posting. Another concept that the chapter introduces is the concept of a T account. Now, a T account is basically a shortcut that we use in accounting. It's a shortcut for the journalizing and posting to the ledger process. And it's a pretty handy tool to use on a regular basis. It's not part of the formal record-keeping process, but it is a great tool to use when you're figuring out transactions, when you're analyzing and classifying, and even recording transactions. It's great for classroom work. And so we're going to show at the top of this sheet our expanded accounting equation, and we will work through part of, or maybe if we have time, through all of problem PA2-2, which was one of the problem assignments for this chapter. So if we move on to problem 2-2, and again, keep in mind, we're working through these problems out of the textbook. When you actually work on your homework assignments, you're going to be working online in the Connect homework tool. So these will be the same problems as in the textbook, except the numbers, the amounts in the problem will all be different. And by the way, these problems are algorithmic. And what that means is that if you're working with a friend side by side on different computers, you can be working on the same problem, but the numbers that your friend has are going to be different from the numbers that you see for the same problem.